Hey everybody, I'm Mike DeSampoli and welcome to the Heritage Market Minute for the week of November 29th, 2021. We hope you guys had a great weekend and a good start to the week. We have a lot to talk about today. There's a lot of things going on in the market. You know, we call this the Heritage Market Minute. This is certainly not going to be a minute today, but we're going to do our best to really pack this in here to give you everything that you need to know. So as we talked about in the Market Pulse on Friday, the holiday shortened trading session on Friday only opened for a couple hours, light volume. And the market got smacked on the news of this new variant, Omicron. Okay, fast forward to Monday. We had a relief bounce in the markets, big moves across the board, markets moving much higher as news started to come out that maybe the variant might be more transmissible, but the symptoms had appeared pretty mild, right? So we felt good yesterday, get a good bounce in the markets. And we wake up today on Tuesday morning and the futures markets are down precipitously. And we go, well, what changed, right? What had the market feeling so bad on Friday, so good on Monday, and now again so bad on Tuesday? And the first thing we want to point out is when markets are bottoming, okay? Bottoming is a process, not an event, right? People think one single day will be a bottom. You look at the market yesterday with a big move higher, you say, well, maybe the worst is behind us. But bottoming is a process, usually a multiple day, if not multiple week event. It appears very choppy, it appears very volatile. But this is how markets carve out a low, if you will, and build a base to move higher. So let's talk about the activity that we saw, right? We saw a big move down on Friday, markets down about 2.5%. On Monday, we saw markets up about 2.5%, right? So wiping out Friday's losses entirely. The big news today was Senate testimony from Fed Chair Jay Powell. Now, if you've been following with us, or you've been with us for a while, you know that this market absolutely hates when Jay Powell gets behind a microphone. We're going to share a chart with you to show you just how much the market hates it. And it's not even that what Powell says, because generally speaking, the market tends to sell off the moment that this man gets behind a microphone. Now, that sounds kind of trivial, right? But why does that happen? Well, the number one thing the market hates more than anything else is uncertainty. And right now we are dealing with a couple different layers of uncertainty. Number one, uncertainty around the Omicron variant, right? How bad is it? Is it bad? Is it not so bad? Highly transmissible? Maybe not. Will it evade vaccines? Maybe not. We don't know these things, right? So that's one level of uncertainty. The second level of uncertainty is monetary policy, right? The Fed has done a lot to engineer this economy and this recovery in stocks, and there's a lot of concerns and talk about future Fed policy and how these things might change. So that's the second level of uncertainty. And then, of course, the third level of uncertainty is how this affects the U.S. consumer, right? If cases start to spike, if people start to pull back on their spending, how will that affect the U.S. economy and the recovery? So we are dealing with many levels of uncertainty, but the market always climbs the wall of worry. This is not the first time we've seen uncertainty, and this will certainly not be the last time we see uncertainty. So there's a couple things at play, but Powell spoke today in front of the Senate Finance Committee, and for lack of a better word, these things are just political theater. We already know Powell's plans. They have monthly meetings for the Federal Reserve with press conferences where they tell us exactly what they're thinking and exactly what their plans are. So these Senate testimonies tend to just be policymakers' opportunity to get a pound of flesh, to get their soundbite, and to ask certain questions that they think might be relevant. Now, what caused the sell-off in the market today, where we saw markets sell off again about 2% across the board before recovering before the end of the day there, was a comment that Powell made about changes to stimulus programs, okay? The Fed has many stimulus programs in place going back to the beginning of the pandemic, and they started the process of tapering these programs, which tapering means slowly dialing them back, okay? Not stopping them all at once, not reversing 180 degrees in the other direction, just slowly dialing them back. A question came to Powell today that said, would you consider increasing the rate of dialing these things back? So doing it quicker, right? And he said, and maybe you'll see some of the headlines later where they'll just extrapolate one piece of this. He said, if the economy continues to remain strong, it would be something we would consider at future Fed meetings. Well, that was all the market needed to hear, and the market sold off, taking that or interpreting that as the Fed is going to tighten up the economy, they're going to raise rates, and they are going to reverse stimulus overnight. That's not what he said, but that's what the market heard, right? And sometimes it's not the news that matters, it's the market's reaction to that news. So he went on to say this new variant does pose a threat or risk to the economic outlook, and it's something that will bear watching. So they will discuss this in their future meetings, December, January, and so on. But again, in a nervous market where maybe buyers are just taking a step back and not ready to buy yet, you got a lot of sellers rushing to the front lines, and this affects prices in the market. So that's the first thing that you need to know. All right, for perspective, the market still only sits single digits away from all-time highs. So the market still is in a good place, and we've seen a lot of internal changes in the market where maybe 2 weeks ago people were getting all bulled up, feeling a little bit greedy, and now we have swung the pendulum strong in a swift way to the other side where everybody is panic-stricken. Not everybody, not our folks, but many retail investors are panic-stricken and running for the exits. This is the time in markets when people should be thinking about buying and not selling. But the stock market is the only place that we know that where things go on sale, people want to sell and not buy. So we're here to keep you calm, to help you invest on, and make sure that we apply our strategy and our plan in a way that will add value over the long term to our portfolio strategy. So that was the big news of the day. There's also some talk that the potential nominee from the Biden administration to head up the banking system, might be a little bit more hawkish, but I think that that's a long way off. There's a lot of Senate nomination committee hearings that we'll go through, so I wouldn't even put much stock into that. Our interpretation of Powell, his statement today, is we think that Powell is taking an approach where essentially he'd rather bark now so he doesn't have to bite later, right? We all know inflation is happening. We all know inflation is something we're seeing in this economy. So he could not step up today in front of the Senate and say, we don't see any inflation. We want to keep low rates forever. We're never going to raise interest rates, and we want to keep the stimulus going. Of course, he couldn't say that. So he had a bout of the policymakers, acknowledge the inflation, and talk about, yes, we maybe would shift course if the data suggests that we should do so. Remember, the Fed is data dependent, and they have two mandates. The two most important things that the Fed cares about is full unemployment and price stability. Now, if the prices in the market are stable, that's one. Employment, we know we still have a ways to go to achieve full employment. So we think this Fed is data dependent. We will take them at face value, and we don't believe that they have any immediate plans to try to do things to upset the whole narrative here in the U.S. economy. Now, let's see, we're going through a couple other things. We saw oil drop precipitously today, so that marks a pretty big decline just since Thanksgiving of last week. We know oil had become one of the biggest inflationary pressures that we've seen. So not all bad news coming out of these things, right? We saw the 10-year yield, which is the market's barometer for interest rates, was down pretty substantially today. It was down about 7 basis points to 1.45%. And we saw oil down another 5%. So oil, after making a relative high just 5 days ago, has fallen a long way in a very short period of time, which should ease some of the pressures, hopefully, when that translates through to the pump. We have seen sentiment in the market, the mood of the market, the mood of investors has cratered from greed back to fear. Okay, we're seeing a reading of 28 on the Fear and Greed Index. Just a week ago, just 1 week ago, it was 64, which was showing greed. A month ago, it was at 72. And a year ago at this point right now, it was at 88, right? So these are contrarian indicators. You want to start easing up on the buying when we get too far to the side of greed. And you want to start thinking about allocating and buying with more capital when we live in the fear category where we are right now. So when we look at this market going forward, okay, we see a market that is undergoing some internal correcting. Not all stocks were down today. Okay, we saw some mega cap tech stocks look strong, looked like they want to move higher. So we don't believe a major top will form in this market when some of the largest market components are still showing signs that they have room and legs to run. When we're looking in this process, this process and any bottoming process, volatility is to be expected. This is what we call a shakeout, right? You shake out some of the weak hands in the market. People maybe don't have a plan or a strategy they want to stick to. They want to sell first and ask questions later. That's fine. People have always been that way. Investors have always been, there's always been investors that fly without a plan, and ultimately, they fall to the perils of their own strategy. But the activity we see in this market, to us, is signaling that the market is trying to bottom, okay? Without different internal oscillators and indicators that we look at it, we won't bore you with that stuff now. But what we're looking for us to see here over the next couple days, over the next week, we'll likely see some clarification from the Fed, right? We've seen this in the past where Powell makes a proposed misstatement, if you will, the markets react, and then the Fed comes out to clarify in the days or weeks later to say, well, wait, hold on a second, that's not exactly what we meant. We still believe that we need to do A, B, and C to meet our policy mandates. So we expect to see that. We also believe the market is very oversold at these levels, and you're likely to start seeing some buying come in, looking for value, looking for discounts. And ultimately, we still believe the U.S. market is in a very stable place. The economy we live and work and thrive in is driven by the U.S. consumer. It's a consumer-driven economy, so the strength of the U.S. consumer is paramount. And we still think this consumer, the U.S. consumer, is very strong. Yes, we have work to do on the labor fronts and relative to unemployment. Yes, we want to see inflation come back down, but we have to remember if inflation is going to persist, inflation does a lot for two primary asset classes, that is equities and real estate, right? The stock market and homes, buildings, commercial, etc. So these are the assets that tend to participate with inflation, not get hurt by inflation, right? Cash gets hurt by inflation, you lose your purchasing power, but we expect these assets to participate. We think inflation will persist into next year, but we don't think it'll be a runaway train where it's going to become a major, major headwind for the markets and the economy. So in summary, to wrap this up, the volatility in the market, we know it can make you seasick. It can make you nauseous, right? Don't stare at price action. This is where long-term investors take a step away, take a step back. Let's look where we're at year to date. We've had some fantastic gains in the markets year to date. And when the market carries these types of gains into December, which starts tomorrow, 8 out of 9 of the last years, the market has moved higher into year end. So we expect a lot of seasonal forces to take place. But of course, if you have any questions, reach out to us. We're always here to talk to you about anything that's on your mind. We just want to give you a little bit more of a detailed explanation today, perspective. We've had some conversations over the last couple of days, and clients ask good questions, right? Well, how can the market be down 600 one day, up 600 the next day, down 600 the next day? That, folks, is volatility, and within volatility lies opportunity. So while many others are running scared, we're pulling up our chair, we're getting up on the edge of our seat, and we're looking for those opportunities to deliver the value to you that you guys have come to expect from us. So if you have any questions, reach out to us. We'll be back at the end of the week for the Heritage Market Pulse. Take care.